Well, greetings, my beloved clients and friends. Today is March 2nd. I've been trying to do a video for about a week, but the weather hasn't cooperated. Then I had a technology issue, so I've been having this on my mind for at least a week, and I wanted to share some thoughts with you. First of all, talk about inflation. Then I also want to tell you about a couple companies I bought recently and a little bit of the rationale behind that. So the PCE, which is a measure of inflation that the Fed likes to use, that report came out on Friday, and it was kind of hot. It was hotter than anticipated, and it gave the market a little bit of pause because growing sentiment was that the inflation problem was behind us, and that was even a sentiment that I shared in recent videos. And yeah, it wasn't great news, but it's not something that I'm overly concerned about. I know that there's still some inflation, and the reason is because the economy is strong, because there's a lot of opportunity, and businesses are still doing well, and technology is leading to advancements that we haven't yet seen and that we could only imagine, and that are, there's news coming out on a regular basis about these amazing advancements in healthcare and technology and their applications for business and so many other things. So with that as a backdrop, we're not going to really see a struggling economy. We're going to see an economy that needs to, that someone needs to kind of pull the reins on so that it doesn't get out of control. And the Fed is doing that now. They took rates from 0 to almost 5, and they're probably going to have to go up to 5, maybe a little bit more, but and then maybe hold on at in that 5-ish range for a while, just to maintain some resistance on this economy that really wants to go. Okay, so that doesn't sound like a big problem. It sounds like a problem that can be controlled, and they're past the period of radical 3/4% consecutive increases in the interest rate, and now they're just kind of adjusting the reins and a 1/4 point here, this and that, and that's really where you want to be. They're in control, but they're on a strong horse, but they're in control. Okay, so I'm not overly concerned. Sure, there's going to be some adjustments, maybe a little bit more than we thought, a little bit less than we thought, or whatever, but they're just adjustments that they're on a strong economy that they need to control. Okay, so that's kind of my take on inflation. And we see a little bit hot read. We know that the Fed is in a position now where they could control it. They could go up or down from 5 a little bit and keep it kind of where they want to be. Now, obviously, they're not going to be perfect, but I think they're in a good position. Okay, so that's really all I wanted to say about inflation. That, yeah, it wasn't a great read, but I'm not overly concerned. But so moving on, I want to talk about, I mentioned that I start doing some buying, and with 2022 behind us, and kind of feels like a bottom was really forming starting in June and really found itself in the 4th quarter. And there's been a sharp bounce from those bottoms. And it wasn't all at once. So some stuff bottomed earlier in October, some later in December. So, but a lot of these growth companies have really bounced 40, 50% or more off their lows. And they're still relatively cheap because they got beat up pretty bad in 2022. So a couple of the companies that we bought have a similar business model. And those two are AirBNB and ETSY. And they're what we would call a platform company, which is a business structure that has really been catching on recently because of the digital economy and because of the ability of people to have at their fingertips a computer, an iPhone that, people are, they're looking at their computer and they're able to do amazing things with that device in their hand, and Google helps them find things, and on the other end, a lot is known about them by what they do on that phone. So it's a boon to commerce in a digital world, right? And so what we're looking for is what companies really stand to benefit from that radical shift in the way we do things in a huge way, okay? And two of them that I've liked and had my eye on and I saw prices that I liked were AirBNB and ETSY. And so let's talk about those. So AirBNB is in the hospitality business. You could say they're a competitor to the Marriotts and the Hiltons and the Hyatts of this world, in that they provide a place for travelers to stay while they're away from home. Okay. Now the difference is that Marriott, Hilton, Hyatt have their own properties that they own or manage, and they have systems to manage pricing and inventory and all these things, that they have really well-developed systems for that. But if a company like a Hyatt or a Marriott wanted to expand, I'm crossing a river right now, so if they wanted to expand, they would, there's the river I crossed, they would have to buy or build another property. If they wanted to, get 100 more rooms or 400 more rooms, it would require first the search for the property, and then the negotiation, and then maybe the construction and or remodeling at the very least. And it would take time, and it would take feet on the ground, and it would take money and credit as well. So on the other hand, how does Airbnb get 100 more rooms? People just sign up, and it's frictionless, and it's costless, and they don't have to. There's not this sales force on the ground that Airbnb has to seek out these properties. They just show up. Someone in the middle of the night goes on there and opens an account and puts a room for rent. Okay, so they have a superior delivery mechanism, and it's an enduring mechanism, and it reminds me of one of Warren Buffett's greatest investments of his career. And it was an investment that he made early in his career. In the early 50s, he was just a young pup coming out of Columbia. And I think he might have saw it when he was still in Columbia. I don't remember. But he was in his early 20s, and he came across this company called Geico, General Insurance Company. And he was fascinated by it. And he went to the company headquarters on a Saturday and tried to get in, and this guy opened the door, turned out to be a high-level executive, and he spent hours just talking to this guy and really got a lot of questions he had about the business answered. And he continued doing his research, and the more he looked into this company, the more he loved it. He shared it with his mentor, Benjamin Graham, and Benjamin Graham, I believe he took like a 25% interest not 25% interest in the company, 25% of his money that he managed, he allocated to this one company. And it turned out to be one of his best, if not his best investments, and a big contributor to his outsized returns over his career. I'm talking about both for Graham and Buffett. And actually some people criticize, some criticism of Graham is that his outsized returns were really based on that one investment. With minus that out, and his returns are arguably just average. Okay, but he did make that investment, and he did make a big commitment to it, and it did get him outsized returns. So I don't know if he should be criticized for making that smart move. But the point is, it turned out to be a great investment that Buffett started doing in the 50s, and he still owns to this day. It's been a 70-year investment for him, and it's been one of his best, if not his best performers. And here's what he saw in that company. He saw that for the way Geico acquired customers was through the mail. They sent out mailers, and people came back and decided to get the insurance. And their insurance was cheaper because they did not have to pay a sales force. And back then, insurance salesmen, they paid that was a lucrative career. My dad was actually an insurance salesman for decades, and so I know they got paid pretty good. But Geico did not have that expense. So how would another insurance company that did have that in the expense, how would they be able to compete with Geico? And Buffett concluded they could not. They could not compete, definitely not on price, ever, because they had that huge sales lag or drain or draw in their expense structure that Geico simply did not have. He called that a durable competitive advantage, aka a moat. And he said that competitive advantage is going to endure for them. And 7 years later, it still is that they still have that durable competitive advantage. Okay, so can you see what's so exciting about Airbnb? That they have a durable competitive advantage compared to the Marriotts and the Hyatts and the Hiltons of this world. I saw this picture. It was of the island of Puerto Rico. And on this picture, there was two pictures of the island of Puerto Rico side by side, like a map. Not really like a photograph, but a drawing. And one showed, like with red dots, where the Airbnbs were in Puerto Rico. Each one's marked by a red dot, right? Like in 2017. And then the next picture was Airbnbs in Puerto Rico. I think it was 2021, like 4 years later. And I'm telling you, the island was almost, at least in the populated area, was completely red. In a very short period of time, there are Airbnbs any place you want in Puerto Rico. There's no way the Hyatt, Hilton, or Marriott could do that. And here's the other thing about Airbnb. They get paid off of the top line. Okay? So Microsoft, Marriott, Hyatt, and Hilton, they have to run a profitable business. Because they have revenue and they also have expenses, right? But Airbnb is almost like a franchise, right? And I owned a couple franchises at one time. There were some Juice It Ups, and I had to pay the franchisor 8% of my top line. So they, regardless if I was profitable or not, they didn't care if I was covering my expenses or not. They got 8% of the top line. So in the winter, when we had months that we're selling 40,000 of smoothies, they got 8% of the top line. you know, we were easily able to cover our expenses. And in the winter, when we're only selling 20,000 worth of smoothies, they got 8% of the top line, even though we were probably not profitable at that time, right? Because we had, you know, high fixed costs. So, and one of the stipulations when we did the contract with them, just to give you some background, they said there won't be another one within 2 miles of you. So we had some protection that way, supposedly, in the lease agreement. Well, a year or two in, I got word that they were going to put one about a mile away from my location. And I said, hey, what's going on here? I thought you were, and they hemmed and hawed, and well, that's really not what it means. And anyways, I lost. They did put one a mile away. And my argument was, hey, that's going to cut into my revenues. And my business is going to cut into theirs. Instead of having one very profitable store in that market, you're going to have 2 maybe profitable stores in that market. Guess what? They didn't care, because they don't care about profitability. Let's say, for example, my store by itself would do $400,000 a year in top line sales. Now with that store a mile away, maybe I was only going to do 300, and that company was only going to do 300 and barely eke out a profit. They didn't care if my sales went from 400 to 300, because net in that market, their sales went from 400 to 600. So they got incremental revenue because they get paid off the top line. They didn't care if our bottom line profits went up or down or sideways. So now imagine Airbnb, and someone says, well, I'm going to rent out this room only in the summer, or I'm going to try it out. That's fine with them, because it's just top line revenue, right? They don't have to, they're not required to say, oh no, you got to be more profitable. You got to list it at least 9 months out of the year. They don't care, because whatever incremental revenue they get paid off of without having to worry about the expenses. Okay, so it's a very, very profitable business for them. Very low variable costs. You know, there's some high fixed costs, but very low variable costs. For that incremental sale, there, you know, that the system has already been built. The software and the infrastructure and everything they have has already been built. It's already been in place. They've already got to the scale where they're covering expenses, and now the growth above that, a lot of it just goes to the bottom line. Okay, and it's very frictionless growth. To add another person, even if you, let's say you're in a market that's some beach community where there's a lot of Airbnbs already, and adding one more is probably maybe going to hurt the other people in the neighborhood, because you know they might have been the only one on that street. Now there's 3 on that street. It might hurt them, but guess what? Net, Airbnb is going to be the benefactor. So we love the business model, that platform business model, where they create a platform. They don't own any real estate. They just are basically a market that unites a buyer and a seller of overnight space, in this case, right? And they're the place to go. And when you become the first mover, you have an advantage, because let's say I have a room that I want to rent out, and I could go to Airbnb, or maybe there's some upstart competitor to them. Well, which one would I rather have? I'd rather go with Airbnb, because, you know, their infrastructure is in place. You know, they have the insurance, they have the size to have all the amenities that I want. They have more people looking at my property, right? Versus maybe some other upstart is going to come out and say, oh, we're going to take less. But so what? You don't have the infrastructure, you don't have the support, you don't have, how am I going to rate the people that are thinking about renting from me? You know, how am I, all that's already been built in. So I would rather, for convenience, just list my property on Airbnb. Same thing if I'm someone that's looking for a place to stay. I'd rather just look on Airbnb because I'm gonna have more selection and I have more protections in place, and there's more capital behind that so that I have certain safeties, right? So once you are the first one in, and once you've established yourself as the dominant position, it's really you're kind of insulated. That why would someone try to knock you off? You'd have to get really greedy or start doing something really dumb to get yourself knocked off that number one perch. So that's what we like about Airbnb. And it got cheap, and it got beat up. I think overly beat up to the point where we liked the entry point and we bought it. Okay, that's a platform business. They own no real estate, but they control vast amounts, and they're able to grow that inventory of real estate very quickly, seamlessly, and for very low cost. Okay, and so that's a company with a durable competitive advantage that has growth. They have markets to expand into globally, and they have a lot of growth in front of them. Because technology has enabled them to have a superior business model to the incumbent, which was Marriott, Hyatt, and Hilton. Same thing could be said of ETSY, and even more so. So ETSY is a place, it's a platform as well, where people could go on and buy craft items from around the world, vintage items. That's really their specialty: craft items and vintage items that people are selling that maybe had a little side hustle of this business that they want to sell their crafts, right? So Etsy doesn't manufacture these crafts. They don't produce them. They don't inventory them. They are just a platform where the buyer and the seller can meet. And same thing, there's a first mover advantage. The first one to define that market and dominate it. Well, then let's say I am like a craftsman that wants to sell my craft. I want it at the most visible place and the most established place and the place that makes it easiest for me to do money transfers and create my website and all that, and so they make it very simple for that person. And obviously I'm going to go there. There might be a competitor to them, but there's going to be nowhere near the traffic or the convenience and the safety and all these things relative to the first mover that's already worked out all those problems, right? Same thing if I'm a buyer. If I'm a buyer, I'm going to get way more selection. It's going to be much easier to shop and navigate and find what I'm looking for, and I have more security that this seller, I could see what kind of ratings they've gotten and verify from other previous buyers if their merchandise is what they say it's going to be, and if their service is good and their payments are smooth. So once it's established, it's hard to knock them off. And who is the incumbent? Who are they competing against? The local farmers market or the local craft show? You think about that farmers market that's open once a week, and somebody that has some crafts wants to get a booth there, and they may get 10 to 20 to on the high end 50 people walking by to see their thing one day a week for a couple hours on a Saturday. And I know some people that do that, and sometimes their complaint is, well, I had to pay $30 for the booth rental, and I sat there and I didn't sell a single thing. or I didn't even cover my booth rent today. And they get excited because some days they'll have a good day, other days they'll have a bad day, but it's hit and miss, and you have to be there and sit there and set up and tear down, and it's only a few hours one day a week, and then, go to the other one. Compare that to putting it on Etsy, where you put it up there and there it is 24 hours a day, and people from around the world are looking at your wares. No comparison. And the shopping experience, there might be some benefit to strolling through a farmer's market and tasting the jellies and smelling the candles and stuff like that you can't, it doesn't happen on a virtual experience. But the ability to just, the selection that you have from around the world, not just from the local craftsmen in your same little town, and not just on, Saturday from 10 to 2, it's 24 hours a day. You can do it in the middle of the night, right? And so what happened was COVID was a huge boon to that company, because people were shut in their room with nothing to do, and maybe they were getting a check from the government. They had money to spend and nowhere to spend it. And so how easy would it be to, at any hour of the day, pop onto Etsy and buy some junk or some craft or whatever, right? And so there was a fear that maybe it was just a COVID company, that they were ideally suited to take advantage of what happened during COVID. And once COVID was gone, that it was going to be a flash in the pan. And so we're kind of on the sidelines looking, is that true? What happens when the economy opens up and this and that? Well, looking at it and analyzing it before we bought it, pre-COVID, they were just growing like gangbusters, about 50% a year, 40 to 50% a year. They were just having amazing growth pre-COVID. During COVID, that growth accelerated even higher. But post-COVID, their growth continued at a slower pace, but it continued to grow. So we saw that as a good sign. Like, okay, this isn't a flash in the pan COVID company. Obviously, COVID gave them some tailwinds, but they're in a position to continue to grow. And you look at their durable competitive advantage compared to the incumbent, and there's really no comparison. They're the first mover, and you think about all the things that they provide to both the buyers and sellers. And I'll tell you a story just to give you an idea of the power of Etsy. So one time we were vacationing in Mexico, and we were in this little tiny village, and my wife, who owned a day spa, we were in this little market, and this lady was selling these sandals, these handmade leather sandals, and they were decorated and painted, and they were really cute, and they were like $2. Okay, and she took one look at them, and she said, I know my clients, they would love these back in America. Like, you get your pedicure and you don't want nothing to hit your nails, so you need an open toe shoe while your nail polish is drying. These would be perfect. People would not think twice about and the alternatives, the manicurist gives you this little styrofoam disposable slipper. Well, he's like, my ladies would love these. They'd easily pay $20 for these. She said, I'll take all of them. I'll take everything you got. And she was right. She took them home, put them in her spa, and they sold quick. But my point is this. In Mexico, that lady in this wasn't a touristy area that we were in. She was in this little village and on this little corner. And who was her market? The other ladies of the village that, maybe these people make $3 a day, you know what I mean? So it was kind of and probably because we were foreigners, she charges $2 each. Probably she sells them to them for $1 each. I don't know. But the thing is, that was the market that she was in. She was in a market where it's very cheap to make, but it's also, you can't sell it for very much. Imagine if that lady could now sell her wares around the world in markets where people make a lot more money, have a lot more discretionary income, she could sell them for 20 bucks, right? I mean, the opportunity that it presents to that lady, and guess what that lady has? She might live in a hut, but guess what she has? A cell phone, a smartphone. You would not believe how ubiquitous smartphones are throughout the world, including the third world. There are businesses in third world villages of Africa where somebody owns a car battery and they sell time to charge people's cell phones. Yes, that's a valuable concern, a viable concern in villages around the third world. And so this lady's able to get money from these people, accept payments, and she could spend that money. She doesn't need to have a bank account. She could go to the next merchant in her village and buy eggs or milk or cows or detergent or wire or whatever she needs, because she's able to accept payments and make payments on her smartphone. She's able to transact business with people around the world for her sandals. So think about the opportunities, especially for women who are often the craftsmen in these third world villages in Kenya and Indonesia or Mexico or wherever, to sell their wares on Etsy and have a profitable business easily, seamlessly. And that would have never happened pre-Etsy, pre-smartphone, pre-Google. And so it's a huge opportunity. And now people could, from their living room or riding the bus into work on their smartphone, they could go shopping in their bed at 1 a.m, go shopping at every farmer's market around the world, in every village and every corner of this world. And that's what Etsy is. And so we bought it around between $120, $125 a share. At that price, it's at about a $15 billion valuation. And our thesis is that this company, within the next 5 years, we would expect to see that the price of that stock hit $250 at some point within the next 5 years. So that would be a double within 5 years, which would be about a 15% annualized return, which we believe we could get. Now, so this company has about $2.5 billion in revenue, and just under 700 million hits the bottom line. That's really good. It's like 25% of their revenue hits the bottom line in the form of free cash flow. And so when we looked at it, we said, well, at 20 times, it's trading just over 20 times free cash flow, which is a number that we like. Often when I'm looking at a company, I'll look at their free cash flow, and in my head I'll multiply by 20 without knowing the market cap of that company. And then I'll look at the market cap, and I'm expecting it to be somewhere around 20. If it's under 20, it's cheap. It's over 20, it's expensive. And so I looked at Etsy and I go, wow, that's pretty good cash flow. I wonder what's the market cap. And when I saw it, I was like, that's all I have to pay for this company? That's pretty good. I'm okay paying just over 20 times free cash flow for a company with the opportunity of Etsy, that's growing, that's been around, that did good pre-COVID, during COVID, is continuing good post-COVID. It's positive cash flow and it's growing, and I easily expect that company to continue growing at about 15% a year. And so my criteria, if I bought it for 15 billion, I'd like to see it at some point be worth 30 billion to give me a double, and would get the price up to from 125 to 250. And so what would require for it to be a $300 billion company? $1.5 billion in free cash flow. And looking at it, where they've been, where they're going, and the opportunity, I could easily see them hitting that number within the next 5 years. and the market valuing them at 20 times free cash flow, and us getting a double on this within 5 years. So that's what we like about ETSY. And I mean, that's just a summary of the highlights of what we saw when we reviewed that company. But it wasn't a whimsical buy, and it wasn't just looking at the company, it was also looking at the stock. It was looking at the price and the value and the growth and the competition and a bunch of other variables. And so for those reasons, we liked it. And that's a brief overview of the analysis and the rigor, intellectual rigor that goes into give you an example of what we think about and how we analyze a company and what we're expecting over time. And we know that between sometime over the next 5 years, the price of that thing could be less than what we paid for it. And but over time, I mean, we're comfortable holding it for a 5-year hold to get a double, and we think within that period of time we could do it. And at that point, if and when it doubles, we'll decide if we want to take our profits or keep holding it if the opportunity continues to look good. So that's just an idea of a couple of things that we've been doing with your money in the market and with our own money, right? Because I buy for you what I buy for me. So I want you to be encouraged, because we're encouraged. We think we know 2022 was rough, and we believe 2023 will be better, and we're making proactive steps to put ourselves on the winning side. And obviously, we won't make every right decision, but we're doing our best to make good decisions for you. So I hope you guys have a great day.